Good morning, I'm Jill Malandrino, Global Markets Reporter at Nasdaq, and it's the first Wednesday of the month, which means David Weisberger is the head of equities over at ViableMkts, joins me for the Market Structure Resolution Update. And David, we're actually going to be at the SDA Market Structure Conference in DC next week. We'll be reporting there live throughout the day. I'm excited about today because we're going to shift away from the exchanges and talk about the buy and sell side. And my question to you is the buy side in the dark?
It's kind of a hard way to answer the question because the fact of the matter is, more or less, yes. The buy side, when you look to evaluate your own executions, needs certain data that they just don't get. And when I'm talking about the buy side, I'm talking about not the quantitative firms who tend to evaluate everything under a microscope, but I'm talking about the average big institutional asset manager who has to fight tooth and nail just to get the data. And what I'm talking about are orders. Because for the most part, for the last 30 years or so, as TCA has evolved, it's been focused on the executions they get, which sounds right because it's trading, except it's sort of like, even though it's not intentional, what I learned when I used to teach magic, or not teach magic, do magic for kids' birthday parties, one of the geek hobbies that I did when I was in high school. And they teach you, get people to focus over here and do the magic stuff over here. So executions are happening, but what you need to understand if you're in the buy side is how and what happens when orders that are sent don't get filled. Are you losing opportunity cost because the market is moving at those times? Or in other words, are you trying to do something and it costs you? Or are you signaling something that people are taking advantage of? And if you don't have all that information,
How would you
you're sort of in the dark.
Right. So the ICI-led buy-side initiative to promote transparency, what do they have to do to achieve that goal?
Well, it's a really good first start. And I commend them because it does focus on orders. One big problem, there's no statistical evaluation in that data. And so to take that and become useful for the buy side, so it's not just why did you send this many orders to this place and get this rebate, should be what was your fill rate on those orders relative to what it could have been. So you can build and construct data that says, if you put an order in a place and it's subsequently traded at that price, okay, we can call that you could have been filled. Whereas an order that was here and it never traded there, well, no, probably it couldn't have been filled almost by definition. So statistics matter. When you're taking and you try to, IOC or ping or other things, there's a lot of mechanics that go on, you can always be filled. So a low fill rate there can be an issue. The second question is what happens when you don't get filled? And so subsequent price movement. So those sorts of things, adding some basic statistics for comparison, in addition to rebates and fees, would be a godsend for a buy-side TCA analyst who's trying to figure out what his trading costs are.
Well, provide us some anecdotal evidence when you were running the quant desk.
So I wrote a blog, actually a full article, which is titled, "Never mind, these are not the orders you're looking for," with pictures of R2-D2 and C-3PO with funny glasses and mustaches. But on that article, I talk about something that actually happened. So this didn't happen once, this actually happened twice in my career. But the most recent time, one of the analysts on my team was doing an analysis of our trading and tried to say, hey, we should do all of our trading passively because look here, the passive orders are trading much cheaper. Well, of course they are. They're not crossing the spread. Whereas the active orders are crossing the spread, so that's bad. And I said to them, okay, that's great. What do you do with the unexecuted quantity? And all of a sudden he goes, what do you mean? And I said, well, when the active orders got executed at what, 90+%? He said, yeah, 94 or whatever it was. I said, the passive orders got executed at what, 45%? He said, yeah, 42 or whatever it was. And I said, great. So when it didn't get filled, how did you price that impact?
Right. Well, why did the aggressive orders fare better?
Well, because you're crossing the spread. You know you're going to get filled. Now, you don't always get filled because sometimes you're trying to buy 1,000 shares and only 500 is there. But more or less, if you're willing to cross the spread, you get filled far more often than you don't. If you're trying to post, you're trying to join that. Well, in this particular case, when I basically had them rerun the analysis, I said, okay, let's just make this really easy. Even if you're trying to buy more than is available, just assume you could get filled by crossing the spread at the time you cancel it. And of course, when they ran that analysis, the sign flipped. The market had moved away and took together the passive orders underperformed the active orders.
Right.
Which makes perfect sense.
But, I mean, how come, are you surprised by the number of buy-side desks that don't analyze the opportunity costs associated here?
Well, I'm not really that surprised. I know that it's a kind of a complicated reason that I'm not surprised, though. There are quite a few very good buy-side traders who totally understand and get the joke. But many of them are paid on the basis of things like VWAP or participation rate type benchmarks, in which case they really don't have an incentive to do so. And there are many others who simply are viewed by their portfolio managers as a necessary evil, and therefore they're not incented to try to do more because they need to encourage the portfolio managers to do things slightly differently in order to track that. But in general, if I were in the senior management of a buy-side firm, I would be yelling about this. This to me is a major reason why active managers underperform passive managers, because passive managers don't suffer this. Passive managers buy into the close. They have a very clear benchmark which they can typically beat or get very close to. Buy-side active managers don't do that.
Right.
And as a result, their slippage from from when the portfolio manager wants to buy a stock can be rather severe, and your ability to capture alpha could be very, very degraded by not knowing.
So the buy and the sell side need to communicate better, and the buy side asset managers need to communicate with their own respective trading desks better, is what it sounds like.
Yeah, I mean, if you think of it very simply, if you're a portfolio manager, you have more or less 3 different types of things that you do, trades that you do. You do trades because you've gotten an inflow of money, in which case it should be identified as such and probably traded into the close just like passive guys do. And because it's going to be a full slice of a portfolio. You have trades that are being done to capture alpha. You believe a stock is going to go higher, go lower, et cetera. In which case, your benchmark should be based on what price you evaluate it at, how aggressive you think the alpha is going to be. Is it 6 months? Is it a year? Is it a day? That's going to be a very different type of trade. And the third is for risk. Now, risk trades are very interesting because people don't think about it, but when you're trading because of risk, it typically is because a sector or a factor ran and had a lot of momentum behind it. In which case, the adjustment is being done not just by you, but by every other. Right. So trading risk trades, you should be very aggressive, try to get them done as soon as possible, because otherwise you're behind. I actually had an anecdote when I was sitting running a TCA business at Market, where a trader told me, we looked at one of their trading strategies, said, this trading strategy, you're getting killed on it. What is it? And he said, it's for risk. And I said, how do you trade it? He said, well, VWAP over a couple days. And I looked at him and I said, so you like being last in the race? And he looks at me and says, what do you mean? And I basically called him an idiot. And he said, you're the first vendor to ever say anything, to ever insult me. And I said, I'm sorry. He said, no, I love it. You're absolutely right. And so they changed their trading strategy. But it's rare that everyone looks at it that way. Now, a lot of buy sides have cottoned on to those sorts of things, but it's rare that portfolio managers tell traders what the type of trade is, how aggressive to be, et cetera, from an alpha perspective. It's always get this done as quickly as you can, as much as you can.
Right.
And I don't want to hear your complaints.
It sounds a little bit counterintuitive. And to wrap this up, it seems as if everyone is employing the same strategy. Everyone's writing the same programs, they have the same algos, they have the same electronic programs going. How do you capture that alpha when everyone's doing the same thing?
Well, there are differences between algorithms, and there are differences between trading strategies. There are some cases where the ability to source natural liquidity, such as people who have humans who actually do that, that's a big deal. There are certain dark pools that do that very well. There are other cases where algorithms are more opportunistic and understand the trading patterns of stocks, know which stocks are more in the dark, which are more lit, where you're better off going to a PSX versus a Nasdaq, for example. Those sorts of things are very true. There's also firms who provide liquidity, and providing liquidity is actually a good thing as long as it's being measured correctly. Right? So there is a spectrum, and there are firms out there who basically just trade on their reputation of, well, we're an agent, we'll do it okay. I'm much more skeptical of those firms.
All right. Well, thank you very much for joining me, as always. And traders, thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.